Hello, guys, and good morning, and welcome to the show. Today is Thursday, July 19th, 2018, and let's open the charts right here. And the first thing we're going to take a look at is a diagram I drew for you guys this morning, for you to look at in paint. I drew it in paint. But here's the thing. I went up and I did some research this morning, and I checked into the price of a new car back in 2011. It's roughly $23,000, and now it's $35,000. A gallon of milk. Now, this is a cross-section, basically, of costs. And basically what I'm doing is giving you an average of what things cost. A gallon of milk was roughly $3.08 back then in 2011, and now it's $3.68. A new home was $243,000, a median home in the United States, in a nice location, you know, a nice home. It's $243,000. Now it's $324,000. A postage stamp back then, in 2011, was 44 cents. Now it's 50 cents. Now, this is just a sampling of prices. All the prices across the board are similar to this, like a chocolate bar, everything, a soda pop, everything you buy has went up in price, especially hardware. Hardware is has went up almost nearly doubled in price. Some things like meat has went way up, and other things went way up, right? There's only two things that I can think of, two things that are cheaper. Take a look at the silver spot price back in 2011, $54.54. Now, this morning, it was, I don't know, I haven't looked at it yet, and we're going to look at it in about 2 seconds. It was $15.15 earlier this morning, and it was dropping. And so for these guys out there who say that the price of gold and silver are not suppressed, my lands, everything else has doubled in price, and silver and gold have been cut in half and cut in half again in price. This is all the earmarks of price suppression. Let's take a look now at the silver chart just for a second. I'm just going to point a couple things out here. If we take a look here at the silver chart over the years, as time has went by, look at what happened in 2008 when we got that deflation. Silver started out at $23.35, and the deflation knocked it all the way down to $10.80. We could be going into a very profound deflationary period, something similar to 2008. Now, look, it started at $23.35 and knocked it down to $10.80, the deflationary period. But you notice a couple things. One, this deflationary period didn't last very long. And what happened when the Fed come out and they announced, hey, you know what, we're going to do this and do that and do everything else. Look what happened to the price of silver once they made that announcement. Okay? Now, if we get a similar deflationary spike event, we could actually see silver prices go down lower than they are now, even. I don't know, maybe even $10. You know, it could go down as low as this spike here, downwards, if we get a deflationary event, something similar to the 2008 event. But just like the 2008 event, they're not going to let it last very long. And when they come out and they announce their programs and stuff, just like they did in 2008, we're going to get a similar bump-up effect. You know, but don't count on buying on the bottom of one of these 2008 type events, because what might happen this time is we might actually run out of silver if we get such an event where they sell. This can cause a sell-off, and we could actually run out of physical silver where you can't buy any, and then if you get a big shoot up like we had after the 2008 event, when it ran all the way up to $54.54. Well, you're going to be awful sad if you don't have any, because this event might be more profound and might be a bigger push up because it might have more of an effect in the 2008 event. So let's take a look at the silver price today. What we see here is just absolute slaughter to the price of silver. It's back up to $15.23, back up to $15.23, but it's taken an awful crushing, you know. It's really, it has. And when I was talking about 15.15, it was down these little bottoms it made right here, but it has bounced back a little bit. But this has been an awful crushing this morning. Now let's take a look at cryptocurrency. A few days ago, back when it was about 6,700 or 6,300 or something like, I can't remember exactly, but I remember saying it, that 7,500 I said it was going to go to, and I said that that's when it's probably going to fall off. Well, we're right at it right now. We're right at the 7,500 mark right this minute, right now, while we're speaking. Let's take a look at the 15-minute chart here. Here we go. We're at the 7,500 mark, and this is where I said it would go to 74.67 right now. And then I said it's going to drop back and make another bottom again, make its third bottom, try to make its third bottom. And so now we're going to have to see if it does what I thought it was going to do, or if it's going to continue to trudge up higher than 7,500. But you can see that mark at 7,500, she leveled out right there, and now I'm waiting to see what it's going to do. But I think it's going to follow what I predicted it's going to do, and I think we're going to see it make more bottoms and give us buying opportunity. So here's the thing: in the next few days, or maybe next few weeks, I'm not going to tell you when to buy Bitcoin. I'm not going to come out and say, hey, you guys should buy Bitcoin today. But what I will do is, I will come out and tell you when I'm buying Bitcoin. There's no harm in me telling you if I'm going to go out and buy a Bitcoin, or not a Bitcoin, I can't afford a whole Bitcoin, but if I'm going to go out and buy a little piece of a Bitcoin, I can let you guys know. So that's what I'll do. I'll tell you when. I told you when I was buying last time, when it was at 5,700. And I'll tell you again this time when I'm buying, you know. And so I'll let you in on that little tidbit of information. And I think there's going to be a time coming very soon. I think it's going to be in the next week or two that I'm going to be buying. I just got that feeling that that's coming. So now, what is the cryptocurrency market capital today? Is 291 billion. And Bitcoin dominance is at 43.7%. This is surprising me how Bitcoin is picking up more dominance lately. I didn't really expect this, but I'm starting to see clearly now. I'm starting to see clearer that I'm thinking it's going to be Bitcoin and Litecoin all the way. I think Bitcoin and Litecoin are going to, I think they're taking over the world of finance. I think that this is going to be a powerful, very powerful thing, especially when they get the Lightning network all functioning properly, and the two coins together functioning through the Lightning network. They're going to be the prestige coins, you know, Bitcoin and Litecoin, and this is where I'm going with this anyway. These are the two kings, the two champs. They were the original ones, silver and gold. Bitcoin was gold and Litecoin was silver. And you know how much I like silver. Silver's my thing. I love silver, and Litecoin is silver. So I love Litecoins, you know, and that's the thing. Now let's take a look at the Dow Jones Industrial Average. 129 points. Well, let me check here just a sec. Let me rewind the page. 131 points up on the down on the day. He's down on the day, 130 points. But that's to be expected because I'll tell you, it's almost right now. The Dow Jones is almost like yawn for me, looking at it, and it's been that way going back for months now. It's been like yawn for me. And I was explaining that way back here when it was like when the Dow Jones was like uh, in March. I was coming on here on my channel to you guys, and I was like, this is not going to crash right away. This is in a holding pattern, getting ready to crash. And I said it's not going to crash until the bond market hits 3.25% or higher on the 10-year. And the bond yield just hasn't got there. So what we're seeing is we've been staying in this holding pattern the whole time. And so it's yawn. As long as that bond yields stay in that holding pattern where they're at right now, this market is going to be yawn. It's going to be boring to watch. It's going to be little ups and little downs and just keep going along in this holding pattern that it's in, you know. But we are seeing an awful drop in volumes lately. Ever since let's see, when did the volumes drop? They dropped right on the bottom of this spike right here on July 3rd. And ever since then, we've seen quite a little drop in volumes, but it might pick up a little bit. We'll have to wait and see. Let's take a look at the oil price today. She's down a little bit. She's down half a penny, 50 cents down, 0.71% on the day. Bonds and rates. Now, here's the thing. These bond yields are proving to be very stubborn. They started to move a little bit this morning, and now the yields fell off again later today, you know. And I've been watching these, and I'm just like, when is this going to start to budge? You know, all these yields are falling today, all the way across the board. I expected upward movement right now, this part of the month. This is doing the opposite of what I expected. This is the only thing in the markets that's doing the opposite of what I expected. But this is what everything hinges on. And so this is kind of weird, these bond markets, and why are they behaving this way? Let's put it this way. I'm doing my research on it. I'm trying to find out exactly what's going on, but it's hard to dig in and find out exactly what's going on within these markets, within this bond market, exactly what's happening that's causing the dynamic that's actually causing these bond yields to actually go nowhere or even fall right now is a little bit hard to find out exactly what's happening. So we're on to it, though. I'm going to be maybe doing a little bit more research into this today to find out what's going on with these bond yields and what's going on with the Fed program. I'll tell you one thing. I got a little a clue to this earlier today when I was looking at the charts. Maybe I'll go into that right now and show you what the clue to it is. On the U.S. 10-year, I was in here and I was looking at the charts, and I said to myself, you know, why aren't these budging? Because on this chart right here, it shows a lot. This is a 1-year chart going back to about February 20th, all the way back to February. What we've seen is it's just been flatlining across here. It's just been treading water. It's just been going nowhere ever since we've seen a rise in yields all the way up to February, and around February 20th or whatever, and ever since then it's just been treading water. But here's the thing. Instead of searching so hard for a reason why, and I'm going to be searching to try to find the reason why later on, if we go to the 5-year, we can start to put this in a little bit better perspective. We can see that right here, in July of 2016 or 2000? No, July of 2016, I guess. We've seen a bottom in the U.S. 10-year of around 1.3%. You know, and if we look at this, what we see is after this bottom right here, we see a steady climb in the price of the U.S. 10-year. We see these yields rising all the way up to now. If we put that in perspective, we can just draw a line between there and where we are now, and all of the rest is noise. But if we go to the top of this peak right here at December of 2016, right? we see a drop-off between December 2016 and 2017, the 9th of 2017, which is quite a long period of time. Yields fell. Okay, so if we take a look between here and here, yields fell for quite a long period of time. But if we take a look at the overall trend, overall over a period of more years, we take more years into example, we can see the rising yields ever since this bottom was set down here in 2016. So if we take a look more at the overall trend, instead of taking such a myopic picture from this peak right here down to this trough here, this little myopic picture in here where we see a little bit of a fall. Now, if we take a look at the overall picture, go into all the years and years and years, what we actually see is ever since we had a peak in the bond yields back in 1981 of, believe it or not, over 15%, we've seen a steady decline until we reached the bottom of around 1.3%. And then we've seen a turn in this market. This is an obvious turn in the market there in 2016, and we see yields starting to rise again. So this gives us a better perspective of what's going on. Yields are rising even though they're not going anywhere right now. They're just taking a little breather, basically, in the overall scheme of things. In the overall scheme of things, these yields are going to continue to rise. This is what I would basically say, and looking at it from a larger perspective, instead of looking at it so closely, standing back and looking at the charts from a longer viewpoint, especially this chart. We've seen the bottom right here. We've seen it making a couple bottoms, and now we see it going back into a bear market. We see the bond yields starting to rise again, and this is not going to stop. The bull market in bonds has ended. It ended right here in the 7th month of 2016. That's where it ended, and now we see the bond yields are in a bear market, and they've been in a bear market ever since. The bond bubble is popping, even though the yields are still very low. It's turned over. The thing's turned over. Okay, so now where are we? We're going to take a look at the U.S. dollar index right now. The dollar is riding really high and strong, and if we continue to get deflation, the dollar's going to ride higher, but this would be the last hurrah for the dollar. This whippy, the dollar's going to infinity sort of a deal. How high might it go? Well, if we get a deflationary event, it could go very high. It could exceed 100 on the dollar index. It could get up to like 105 if we see a deflationary event. But when it gets up to 105, don't think, hey, you know what, silver will be $5 and I'm going to run out and buy my silver. There won't be any silver available. Somebody else, when it gets down to that price, somebody else will snatch it all up ahead of you. That's what's going to happen. That's what always happens, you know. It's just like you open up the newspaper, you see this car, it's what you're looking for. Say it's a 2015 whatever, and the price is only $1,500. You can't believe it. It says blown head gasket or something like that. It just needs to replace a head gasket. So you run to the phone. It's going to be a real bargain on a car. You're going to get yourself a great car, you know, a late model car with only say 50,000 miles on it for that kind of money, you know. And there's been 10 people phoned ahead of you, and the guy has already got it 2 hours before you. That's what'll happen with the silver. If you don't get it while you can get it, you got to do what's called cost averaging. What you do is, when it's cheap like it is right now, you buy some physical silver and put it away for yourself. If it goes cheaper, you buy more physical silver and put it away for yourself. If it goes cheaper yet, you buy more. You keep buying all the way back down to the bottom, and don't sell it, because if you sell it, that's when you incur your loss. If it goes cheaper and you get nervous and you sell it, that's where you incur your loss. Think long term. keep buying and cost averaging all the way and hang on for dear life. Because at a certain point, silver's going to reach its final bottom, and then we're going to go into the biggest bull market in precious metals you've ever seen in your life. But there will be none available in the start of that new bull market. For, say, the first 6 months, there's going to be none available to buy because the price will be skyrocketing. When it gets up to a certain price level, then it'll become available again, but you're not going to want to buy it then because it's going to be so expensive. That's what's going to happen. So listen, thank you guys for listening to this market report. And we'll catch you again, let's see, on Friday, and then the weekend's coming up again. So bye-bye, guys, for now.